Good morning. I'm Worcester Business Journal publisher Peter Stanton. It's my pleasure to welcome you to this morning's Economic Forecast Forum. We are thrilled to have a top-notch lineup of speakers today, including two economists and two local business leaders who are going to share their view of the current conditions and where they see our economy going from here. Pulling this event off every year takes a lot of planning, and we appreciate the support we've had for many years from our sponsors. So I'd like to thank our longtime presenting sponsor, Bank of America, our corporate sponsor, Bolus Lynch, and our supporting sponsor, National Grid. Before asking our presenting sponsor to share some opening remarks, just a couple details I want to review with you. Number one, this event is being recorded and will be shared with all registered attendees post-event. So if you have to get up and go to the bathroom for 2 minutes, you can have that 2 minutes filled in. We'll get you the tape. To ask a question, simply type it into the Q&A box located on your screen, and our moderator will try to get to as many of those as possible during the discussion period. At the end of the panel discussion, we're going to reveal how the amateur economists from last year's economic forecast event did predicting the future, recognizing the most accurate prognostications for where the Dow, unemployment, and inflation would land, and crowning an overall winner as our economist of the year. So listen closely to the presenters, take good notes, and you'll be ready to take this year's survey and be in the running for next year's top prize. So now it's my pleasure to introduce the spokesperson for our longtime presenting sponsor. That is Michael Garand. Michael is the managing director and private client advisor for Bank of America's Worcester private banking team. And Michael's going to share a few welcoming remarks. Michael, you're on.
Thank you, Peter. Thanks for that kind introduction. Let me start off, and good morning, everyone. Let me start off by saying how proud Bank of America is of our longstanding relationship with the two phenomenal institutions that have made today and so many other forums possible, the Worcester Business Journal and the Chamber. Two organizations that are perfectly aligned with the driving purpose of our company, which is to make people's financial lives through the power of every connection. Like everyone on this call today, Bank of America is deeply invested in making sure Worcester's economy is thriving. We do that by driving responsible growth through our 8 business lines, growing and winning with a customer-focused strategy, and meeting the financial needs of our customers, clients, and business owners in a manner that helps them achieve their life priorities. We also want to ensure we're supporting this community in a way that truly makes a difference. That's because we know we're only as healthy as the communities where we do business and where our 5,000 Massachusetts employees live. Bank of America has a long-standing history in the greater Worcester area. One of the elements that makes this community so special is the investment we all make through philanthropy and volunteerism. It truly takes a village, and our company is proud to play a role alongside so many of the corporate and civic leaders on this call today. In the past 2 years, right here in central Massachusetts, Bank of America has invested over $1 million in grants and sponsorships to build economic pathways through community development, workforce training, and addressing critical needs such as hunger and housing. Furthermore, our employees across the state donated over 10,000 hours of volunteer time on average a year, working with a broad range of local community organizations. We are extremely proud of the countless financial literacy hours that we have provided to key organizations such as Habitat for Humanity, Boys and Girls Clubs of Worcester, and numerous other organizations such as Seven Hills and our newest partner, E4All. And we are very proud to announce that in the last month, we challenged all of our associates to improve the health of each of our colleagues through taking the booster shot. And for everyone that completed the shot, we would donate $100 to the Worcester Food Bank. I'm proud to share that this month we will be awarding the Worcester Food Bank with a $25,000 grant for the efforts of all of our associates as we work to press out hunger in Worcester. I'm joined on the call this morning by several of my colleagues, familiar faces in the community who bring our world-class financial expertise to Worcester every day through commercial banking, private banking, Merrill Lynch, wealth management, business banking, and our financial centers. It's terrific to see so many of our clients on the call today, to whom I'd like to extend a special, sincere thanks for doing business with Bank of America. We appreciate and truly value the trust you put in us, and we're grateful for the opportunity to have you as clients and customers. Ultimately, at Bank of America, we are asking each of our customers and clients one simple question: what would you like the power to do? As I think about the growth in our great city going forward, that can mean many things to many people, but I will leave you with that one thought. Peter, thank you for the important work you do in a vibrant Worcester economy and for convening such an event like this. Bank of America is honored to play a role in today's program, and we're looking forward to an interesting dialogue. Thank you, everyone.
Appreciate it, Michael. And for those in attendance who were at the Worcester Economics Club just a week ago, Michael also gave some welcome remarks. So, that because Bank of America is sort of supporting those events as well. So we appreciate all you do for the community and in supporting forums like this one. And just as a little tease, one of your associates finished in the top 3 on the Economist of the Year. So let's stay till the end and see who that was.
He's been bragging about it, Peter, for a long time.
I'm sure. It's now my pleasure to introduce our moderator for today's forum, Carrie Saldo. Carrie is an independent journalist and the former Worcester.
Chris, does it look like we may have lost Peter? Should I move ahead?
Sorry about that. Yes, please do. Thanks, Carrie. I will finish introducing you. Carrie is an independent journalist and former Worcester reporter for GBH News, an experienced and award-winning print, broadcast, and digital journalist. She's interviewed the likes of Senator Elizabeth Warren, Congressman Richard Neal, and the artist Krista. So she's certainly ready for this morning's conversation. Thanks again, Carrie, and the floor is yours.
Happy to be here. Thanks so much, Chris. I was thinking about, moderators. One of our roles is to really warm up the room, in this case, the Zoom room. I was looking on the internet for some jokes, and let me tell you, there are some really, truly terrible jokes about the economy on the internet. So if you're looking for a quick Google, let me just share one of the worst with you here this morning. So it goes like this. A friend of mine owned a balloon company, but he had to close it. Couldn't keep up with the cost of inflation. Yeah, I told you, really, really bad, right? One of the tricks with moderating is just set the bar truly very low. I think I've done that. Now we can move ahead. So we'll begin this morning hearing economic forecasts on the state and the nation in just a bit. And then later we'll get some regional context from our panelist, Aaron Berth of Global Solutions, Solvis Global, and David Fithian of Clark University. But first, those forecasts. Here to discuss the thoughts on where the national economy will head in 2022 is Dr. Slavik Sheremirov. He is the senior economist with the Federal Reserve Bank of Boston. Thanks for being here, and take it away.
Good morning, everyone. It's my pleasure to be here. Let me share my slides with you. Let me first thank the organizers for inviting me to present in this very interesting forum. I'm going to give remarks on national economic conditions and outlook. Let me emphasize that all views expressed in this talk are my own, and they don't indicate concurrence by the Federal Reserve Bank of Boston, the principals of the Board of Governors, or the Federal Reserve System. So let me overview my presentation first. So as you all know, national economic conditions have been significantly affected by the course of the pandemic during the last 2 years. The underlying economic fundamentals are by and large strong, but the unpredictable COVID waves make problems for businesses and consumers and also lead to reallocation of resources and reallocation of consumption. So the forecast right now is quite optimistic as far as economic activity is concerned. Absent new COVID variants, the economy should continue its robust growth in 2022. But of course, the unpredictability of the emergence of this new waves is a major concern. Another major concern is inflation, which is currently high. So we've seen headline measures of inflation running at 7% on a year-over-year basis, and it's concerning. And so I would like to point out two channels that contributed to high inflation. So one is high demand for goods and reallocation of consumption from services to goods due to pandemic. And the other one is disruptions in the global supply chain. And I'll try to talk about the first one in particular in more detail later today. So on the labor market side, labor markets are quite strong, and the economy right now is likely close to full employment. If anything, it's hard for firms to find workers, and there's a lot of competition for talent. There could be a little bit of slack in terms of labor force participation and a little bit more room to grow. But the decline in labor force participation is also likely due to demographic factors, in particular early retirement that a lot of people took in response to COVID. Wages are rising fast, although not as fast as inflation, and so real incomes were falling. But it remains to be seen if this trend is going to continue later in this year and going forward. So let me show some charts. I would like to start from looking at the economic activity, in particular in real GDP growth in the previous year. And so on average, the growth rate in real GDP during 2021 was about 5.7%. So this is far above than the historic average, but of course, much of that was to recover the loss in production that happened over 2020. And so we expect that going forward, and I think a lot of forecasters agree with that the growth rates are going to be smaller than what we observed recently. They're likely to be elevated in 2022 to make up for that loss, and then they're going to converge to the averages or to the trend later in the next year. So I'll show you one of the forecasts from private forecasters, and basically the expectation is that some elevated growth in 2022, going down in 2023. Now, it's interesting that there's low expectation of growth in the first quarter of 2022, which is mostly due to the effect of the Omicron wave. And it shows again how unpredictable the forecasts are right now, because the emergence of new waves and new variants, they really affect economic activity on a short notice. And so this forecast was revised down from the previous forecast exactly in response to that. One sector that is particularly affected by the pandemic is services. And so I wanted to show a few graphs related to that. So this graph shows the number of seated diners at US restaurants in 2020 and 2021 relative to the benchmark before the pandemic. And so we see that when the pandemic started, basically almost no one was going to restaurants. And then demand started to recover later in 2020 as pandemic subsided. And then with more waves, demand went down. And then every time we have a new wave, there is sort of a wiggle going down. And a similar situation happens with travel. So this is data on TSA checkpoint throughput. And so again, a huge decline in demand at the onset of the pandemic, then some recovery. And then by the end of 2021, so demand for restaurants were actually close to the pre-pandemic period. The travel demand was here about 20% below that it was in 2019. But then with the emergence of the Omicron, this number started going down again. And so it really shows how unpredictable these things are with the pandemic. And so let me talk a little more about inflation now. And I think to understand inflation, it's really important to look jointly at prices and demand or actually consumption for particular categories. And so just to avoid the conversations about the base effect and that the prices went down in 2020 versus 2021, versus 2019, I'm going to compare the price indexes and consumption indices relative to December 2019 period. And so we see this decline in consumption in 2020 and then recovery. But then in 2021, consumption growth was quite sluggish. And so at the end of the year, real personal consumption expenditure was about 3.6% above what it was 2 years before that. At the same time, prices increased by 7.2%, and a lot of that increase happened over 2021. So prices were falling in 2020 and then recovered a bit, and then really started to take off in 2021. So I think these two graphs already tell us something about the relative role of demand and supply. We know that if demand is the major channel, we would see an increase both in prices and quantities and consumption. If supply is a major channel, we would see a decline in consumption and rise in prices. And so here we see that really consumption didn't increase by that much. Now it's important to look at particular categories. So let's start with services. So services, consumption of services is still below what it was in 2019, about 0.2%, almost converged now. And inflation for services over a 2-year period at 6.3%, while high is below the actual inflation rate. Now, what's important to note is that during this period, there was a big shift from consumption of services to consumption of goods. For example, consumption of non-durable goods increased by 11% over the 2-year period, and inflation in the durable goods, non-durable goods was 6.7%, slightly higher than of services. Why did this happen? Of course, because it was hard to consume services in person, it was risky, and so a lot of consumers just opted for consuming goods instead that would be purchased online. And one can in particular see a jump in consumption of durables here. So overall, it's 15.3% above the December 2019 level, and also very high inflation, 12% over 2 years in the durables goods sector. And so while we already can see that inflation in the durable sector was particularly high, the trend before the pandemic was for the prices of durable goods to go down. And so not only they didn't go down, they actually increased by more than prices of other goods. And some of the supply side constraints that have been highlighted recently, such as disruptions in the global supply chains, they disproportionately affect the durables. And so to the extent that those constraints relax, we can expect that inflation will start going down. But because much of the world is still struggling with the pandemic and the vaccination rates are much lower in developing countries, there are different lockdown policies in place, it's actually not clear when those constraints will relax completely. And so it's likely that these pressures will be there for some time, and sometime that they will ease for a moment, they may become a little harder again and ease until the pandemic is over. So let me look at particular products. So where do we see most action? So we see that prices for used cars and trucks increased by 54.6% over a 2-year period. And that was one reason why a year ago, a lot of economists thought that inflation was largely temporary. It was coming from a few selected categories, and the expectation was that perhaps when those idiosyncratic shocks subside, we would not see a lot of inflation in other sectors. Well, besides used cars and trucks, now we see rising prices in energy that tend to be volatile, but there's overall 22% increase in energy prices over the 2-year period. We see also rising prices for food, and a particular issue with this category is food and energy, that those prices are salient. So consumers see them, they shop for food frequently, they buy gas frequently, and so they observe rising prices and they form expectations based on those prices. So now inflation actually spread to other sectors as well. So we see smaller increases in other sectors. So rents, for example, increased by 6% over the 2-year period. A lot of that increase happened over the last year, actually. See an increase in medical care services and so forth. So in most categories now, there's some increase in prices, and we rarely see any decreases. So one important gauge of what will happen with inflation going forward is inflation expectations. Inflation expectations tend to be self-fulfilling. So when consumers expect more inflation, they change their consumption decisions to increase demand, and that generates more inflation. Firms also change their pricing decisions and expectations. They change wages, and so overall the price level starts going down. So looking at medium-term inflation expectations that focus at expectations of a 5-year period, we see a spike over the 2021. So historically, over the last 5-year period, at least, inflation expectations by professional forecasters were anchored at 2%, in line with the FOMC target. And then when the pandemic started, we saw a little bit of inflation, expectations adjusted for a moment. And then once we started seeing inflation in the data, professional forecasters responded right away. So at the peak in the previous quarter, the expectations were 2.6% over a 5-year period, but they finally started to come down. And I think that professional forecasters are now listening to the communication from monetary policymakers, and they expect monetary tightening going forward that will reduce inflation. And so now there's a downtick to 2.4%. We'll see where it goes in the next quarter, but at least it's a positive sign as far as expectations are concerned. On the consumer side, this measure is a little harder to gauge. So consumer expectations were elevated for a while, even though we didn't observe inflation above 2% before the pandemic. And then now they went up to 3.5%. It's a mild increase. I don't think it's critical in terms of generating self-fulfilling inflation, and it remains to be seen if it's going to go down in the future. Now, financial markets expectations that are often measured by the spread between the 5-year nominal rate minus the 5-year TIPS rate. They were going up for a while, and now they started coming down as well. So the last observation is at 2.8%. So overall, all these measures are slightly elevated, but they're not at the critical level to expect that we'll see a lot of self-fulfilling inflation going forward. The labor markets are quite strong, so I would even say the economy is quite close to full employment right now. So the unemployment rate is at 4%. That compares well to the 3.5% right before the pandemic. We still see a little bit of softness in labor force participation rates. So it was running around 63% before the pandemic started. Then there was a drop, and now it went up to 62.2%. I don't think a lot of economists expect this measure to go back to where it was, in part because of population aging and a lot of folks taking early retirements during the pandemic. Also, some workers started their own business, so that they're also not on labor force by that measure. And so it's likely to be somewhere below 63%, but maybe there are a few tenths that it can still recover in 2022. Because of tight labor markets, wages are rising as well. So this is one measure of wages, the employment cost index that measures wages and compensation. In 2021 Q4, it increased by 4% relative to the same period in 2020, and it was the largest increase in nearly a 20-year period. So clearly wages are rising at a high rate, which reflects the fact that there is a shortage of workers, and it's generally hard for businesses to find workers, and there's a lot of competition for talent at the moment. There is a concern that rising wages and rising prices may reinforce each other. And so because wages are rising, prices will rise more, and because prices are rising, workers will demand more wages. And so this is going to be a race to the top in terms of the measure, but which is really a race to the bottom. But I don't think there's really evidence of that in the data right now. In particular, I think what economists care the most is real wages, and real wages were not putting a lot of pressure on prices right now. So in 2020, real wages were increasing. So here are the two measures, the real hourly earnings, which is a measure of wages, and real compensation, which is wages plus benefits. So the compensation increased by 1.2% over 2020. The real hourly earnings increased by 4.1%. But over 2021, real wages were actually falling because an increase in compensation did not catch up with an increase in inflation. And so overall, real compensations are now 0.5% below what they were in December 2019, and real wages about 3.3% above. So this is a growth rate over a 2-year period, so it's not particularly high. This is not to say that we won't see more pressure from wages. It's likely that wages may lag price increases, in particular because in many contracts, wages get reset once a year. So perhaps many firms budgeted a larger wage increase for 2022, and we'll see more increase in wages, and included in real wages. But at least based on the previous data, we don't see too much pressure from wages into prices based on this real wage measure. And so let me conclude this presentation by stating again that despite the uncertainty of the pandemic, the outlook is positive, and the robust economic growth is widely expected in the near term. Labor markets are particularly strong, and the main concern right now is inflation, which is clearly high, but should eventually decline in light of expected monetary tightening and also easing of supply chain constraints once the pandemic wave subsides. I would also want to talk briefly about possible risks to this outlook. So of course, the pandemic is one of them, and low vaccination rates around the world and intermittent restrictions in many developing countries are a particular concern. We're still not sure how the pandemic will look during this year, and there's an issue with the possible emergence of new variants, new waves. And on the inflation side, I think that there's an emerging threat coming from rising energy prices. And because, as I mentioned earlier, energy prices tend to be absorbed by the consumers, there's a risk that with more energy price pressures, we'll see more inflation and a rise in expectations. But it still remains to be seen if the recent increases will be sustained going forward in 2022. So with that, let me conclude my remarks.
Dr. Sheremirov, thank you so much for those remarks. Really appreciate them. And let me move forward now and invite Mark Melnik, the Director of Economic and Public Policy Research at the UMass Donahue Institute. Mark's here to discuss statewide forecasts for 2022.
Okay, thanks, Carrie. And good morning, everybody. And thanks to the WBJ for the invitation to come speak this morning. I give a lot of these talks over the course of the year, especially this time of year. And my staff and I, affectionately refer to this as the road show. Hold on a second. It was interesting when I was doing this a couple of years back. It felt like I could just kind of roll out of bed and give the talk. This is probably 2019, 2020, and even joked with my staff in January 2020, saying the road show's gotten kind of boring. Kind of saying the same stuff all the time, and then obviously be careful what you wish for, because everything since then has been an evolving conversation about what's been happening in the economy and its impacts. I think what is interesting about my presentation relative to Slav's just a minute ago was that the conclusions, and I think the forecasts are quite similar in terms of what the economic principles or what the principles of the economy are right now, and what in the kinds of position we are, generally speaking, both in terms of what the outlook looks like, but also where the question marks are, especially, I feel like for the last 2 years, even though the economy keeps changing, I think the biggest thing I keep pointing to is instability and the difficulty in being able to predict where the future goes when public health is defining the economy. But with that said, we are 2 years into this thing, and it has allowed us to really talk about this in some really different ways. So I focus on this in a slightly different way than Slav does, but I think they complement each other quite well. And I'll be focused more specifically on Massachusetts and some of our regions. But Massachusetts operates within a national and global economy, so a lot of the things that you guys just saw, are reinforce some of the things that I'll be talking about in a more local context. When I think about the COVID crisis, though, I really think about it in three parts, right? There is the characteristics of our economy pre-COVID. There's the shock of the COVID crisis and what it did in its immediate aftermath on the local, state, national, and international economy, and then kind of like living through a COVID economy now, right? I keep wanting to transition to our post-COVID conversation, but obviously we're not in a post-COVID world yet. And but the economy has continued to move forward. And what do those things look like? So with that said, let me get into it. First, and real quickly, I like to start this conversation by at least, acknowledging or at least setting the stage about where we were pre-COVID. And I don't do a lot of slides on it anymore, but I think it's worth noting when we think about Massachusetts, that Massachusetts was and is the fastest growing state in the northeastern part of the U.S. And part of that is separate from that, but related, is Massachusetts was also the leader in job growth in the northeastern part of the U.S. And a lot of that was driven by Greater Boston and Cambridge and the economic activities in the eastern part of the state, particularly post the Great Recession, where the Massachusetts economy was positioned well to recover. The Great Recession didn't hit us quite as hard as other places, but the industries that grew post Great Recession were things that we had in strong abundance in Massachusetts, particularly in the tech, bio, and other knowledge-based industries that were really strong in the eastern part of the state and as well as in the central. But that said, the prosperity that we were experiencing in Massachusetts was not evenly felt throughout the state. The more vulnerable demographic groups and regions were not experiencing the same economic growth. And as a result, these were populations that were more vulnerable when the pandemic started. And one of the critical things about the COVID crisis, which I don't have a slide on anymore, and I was somewhat limited in today's talk, but the COVID crisis was without question the most unequal recession on record. And what we really found with COVID was truly being a kind of great revealer of social inequality in the United States and globally. But those populations that were not positioned well in the economy or were more tenuous were the ones that were most severely impacted by the economic downturn. So let's turn to the COVID economy. So first, looking at the unemployment data, and just to orient folks, this looks at national in Massachusetts unemployment dating back to 1976 to today. Those vertical gray bars that you're looking at there, those are recessionary periods. And the thickness of that bar is the length of that recession. So you can see here with the Great Recession, that was a long period of time. Oh, excuse me. There was a longer period of time for a recession. Historically, Massachusetts is the blue here. Historically, Massachusetts unemployment rates are lower than the U.S., and that's been particularly the case in the last 10 to 20 years. Part of that is the concentration of industries, again, that we have in Massachusetts and our strengths in knowledge-based industries, higher education, healthcare. Those were industries that were less severely impacted during the Great Recession, as we see this kind of separation between the U.S. and the national unemployment rates. And then over the recovery period and the growth period of the Great Recession, Massachusetts continued to have a stronger economy than the U.S. overall. Introduce the COVID crisis, Massachusetts had one of the worst, we're one of the most severely impacted states during the economic downturn. Unemployment spiked to 16.4% in Massachusetts in April of 2020. The northeastern part of the U.S. suffered unemployment at a much higher level than other parts of the U.S., in part because COVID started here first. And then some of our states took much more aggressive measures in terms of social distancing. So that led to this kind of spiked unemployment in Massachusetts and a lag in recovery over the next couple of years. Currently, though, the unemployment rate in Mass and the US is the same at 3.9%, as Slav mentioned in his presentation. It's pretty much full employment and unemployment rates that folks would have been jealous to see in 2007, 2008, 2009. We've been spoiled because of the extraordinarily low unemployment rates pre-pandemic. So on using unemployment as a measure, things look pretty strong in the economy right now. What we did see, though, is that there were significant disparities in how the economic downturn impacted different populations. This graphic here shows on the left, and again, we're looking at Massachusetts, the unemployment rate for men and women. And on the right, we're looking at folks with a college degree and folks without a college degree. When we look at gender, the unemployment rate for women spiked during the pandemic. Separately, we know that labor force participation declined dramatically for women during the pandemic. Part of this was a relation to two core things. Service-based industries were the ones that were most negatively impacted during the pandemic. And so as a result, populations that are much more likely to be working in service-based sectors, women, people of color, young folks, folks with limited educational attainment, these are all folks who saw unemployment rates spike. And then separately, because of the family and other household needs that presented themselves early in the pandemic, we saw labor force participation rates decline dramatically for women. That said, the unemployment rates between men and women have come close together, and the labor force participation rate comparisons between men and women look a lot more similar to pre-pandemic. So the elements of the C-cession are seeming to have at least subsided. On educational attainment, we see a very similar story with folks with limited educational attainment having a dramatic increase in unemployment early in the pandemic, including spiking to nearly 30%. Now that difference has declined, pretty significantly, but unemployment is still quite high for folks with less than a college education in Massachusetts, being near 10%. And that's an important story here when we talk about hiring challenges for employers, because as Slav mentioned already, we have a lower labor force participation rate on the one hand, but secondly, the folks who are available right now in the labor market tend to have limited educational attainment. So there may be a skills mismatch between opportunities that are available versus the folks who are currently looking for work. Looking at other populations on unemployment, this graphic on the left looks at communities of color compared to white, and the graphic on the right looks at age. Similar story, and I kind of set it up already, but when unemployment spiked at the beginning of the recession, the impacts were much more severely felt with communities of color. Because of sampling issues with the current population survey, people of color mutes this some of the effects, because this includes white, Black, Hispanic, and Asian. The unemployment rate for the Asian population, though, tends to be lower and similar to white. So what we do know is that there was significant spikes in unemployment for the Black and Latinx communities, and a lot of populations that were working again in service sectors. When we flip to age, similar story again, and we see young people, 16 to 24 in particular, there's a lot of volatility with their unemployment rates. And we see that here as the unemployment rate spikes dramatically for young folks, and then has been coming down over the last 2 years. So we're 2 years into the pandemic. What does the recovery look like? Well, first, looking at business confidence, this is the AIM index that is done every month, looking at business confidence in Massachusetts. A score of 50 is kind of neutral. If you're above 50, it's positive in terms of business confidence, and if it's below 50, it's negative. The data here really just kind of matches where the waves are in COVID, and I think is an important part of the connection between public health and economic and the economy in general. And as we see the introduction of Delta and Omicron, that business confidence began to wane. It recovered significantly throughout 2021, and then the moment the waves started kicking in, business confidence went down. And it's not terribly shocking, but the data at least reinforces those concerns about the volatility in the market and the lack of predictability, especially as it relates to COVID. An important story right now in Massachusetts, and Slav mentioned it a bit at the national level, has been the impacts on labor force participation rate, and also in general the size of the labor force. The graphic here dates back to 1976, and the blue line shows the incremental increase of the size of the labor force in the state, and then the decline dramatically in labor force participation, or the folks who are either employed or looking for work. Over the last 2 years, that has incrementally increased, but we're still below pre-pandemic levels. And this is an interesting trend, because labor economists have been pointing for years about concerns about declining labor force size in the US as the baby boom population approaches retirement ages. In some ways, it feels like as the COVID crisis maybe sped up a issue that was coming for us eventually, with baby boomers opting to retire early. So this does inhibit economic growth. And is probably one of the bigger long-term concerns that I have right now is where is the supply of labor going to come from? And we've seen this flat in even this weird decline in the month of December, where our unemployment rate went down. Part of it was because more people were employed, but part of it was also because we had 40,000 people drop out of the labor market. So this is a big concern going forward, just in terms of how economic growth occurs in the state. And we have this one problem with, folks maybe opting to retire early, or baby boomers retiring in general. But the second part of it is also just, which I'll touch on a little bit later, has been population growth in general, and Massachusetts in particular has leaned heavily on immigrant labor for the last several decades, and some trends that are going on over there. So we've talked a bunch about how we've been recovering jobs pretty steadily over the last 2 years. This graphic here shows the decline in jobs, or how short we were from the pre-pandemic peak in Massachusetts every month. So in April 2020, we were down 692,000 jobs in the state. We've seen that number steadily going down, but we are still below peak. We're about 155,000 jobs below the peak of where we were pre-pandemic. In a longer presentation, I dig in a little bit about where the impacts were on this. But what's important here is that things like service-based industries had a disproportionate impact or a disproportionate share of the lost jobs in April of 2020. But interestingly, still a disproportionate impact even now. So when we think about, I think I'd have to look at the data again, but I think we're close to like 50% of the shortage here is in things like leisure and hospitality and food, as well as different elements of healthcare. So that was a significant part at the beginning, but it's actually proportionally a bigger piece now. So those are sectors that are still lagging. This next graphic touches on that a bit further. And just to orient people, the yellow is jobs lost in April of 2020. The red is the jobs gained as of December 2021. We're still playing around with how to display this, but the important thing to highlight here is that everything lost jobs, right? So that yellow is the first piece. In the further apart the red is from the yellow, the more recovery that industry needs to do. There's a few rare instances where the red overtakes the yellow. Professional and business services, which includes a lot of knowledge-based industries, high tech, life sciences, and so on. This industry is actually bigger than it was pre-pandemic in Massachusetts. Same thing with construction. Same thing with some elements of transportation, warehousing, utilities, but that's a smaller industry in general. But what we see here in these instances of where the yellow far outstrips the red, and those are industries that that are still lagging way behind on jobs from where they were pre-pandemic: leisure and hospitality, education and health services, retail. And so we continue to play around with how to demonstrate that, but I think it's a critical part of seeing like where the recovery still needs to occur. So how does Massachusetts compare to other places? Well, this next graphic shows job recovery rate for each state in the US, including DC, between February 2020 and December 2021. We have recovered about 96% of our jobs from pre-pandemic. That's pretty good. That ranks 37th in the nation, though. But we have a thick middle here where a lot of states are in that 96, 97, 96, 95 range. Some states actually have more jobs than they did pre-pandemic: Utah, Idaho, Texas, Arizona. And then some that are way below their peak. Hawaii is particularly interesting, and not one that I talk about often in presentations, just because we don't share a lot of similarities with Hawaii, but just kind of underscores the leisure and hospitality issue too, that Hawaii is 12% below its peak pre-pandemic. But for Massachusetts, there's room to grow. We're similar to a lot of states, though, in terms of where our recovery stands. Comparing Massachusetts with in some of our regions on recovery, we look similar to other northeastern states. On the left, we see all the northeastern states and their recovery of jobs. New York and Vermont are lagging pretty significantly, but we look similar to Maine, Rhode Island, Connecticut, percentage point behind New Hampshire. In terms of the MSAs, one of the things that we're trying to track is how the recovery looks different in the metropolitan statistical areas around Massachusetts. Right now, it looks a little clumpy, where the recovery looks somewhat similar for most places. Barnstable MSA, which is mainly the Cape, is about 96% recovered. Other MSAs in the state are in that 95%. Worcester's lagging a little bit at 94%, and Pittsfield at 93%. This is something that we're going to continue to track because that was a big part of the story in the recovery of the Great Recession, was how slow other parts of the state were to recover relative to Massachusetts, relative to Boston. Places like Springfield took, nearly 10 years to really fully recover, whereas in Boston was much faster. I want to talk a little bit about population change, because that gets at the labor force participation story. We continue to be the fastest growing state in the Northeast and compare pretty well to other parts of the US. Between 2010 and 2020, the US grew 7.4%, and Massachusetts did as well. Most Northeastern states actually grew at a much slower rate. Population growth, and it's been this way for decades, has been fastest in the southwestern parts and the southeastern parts of the US and other parts of the West. But Massachusetts has done pretty well in terms of overall population growth decade over decade. That said, the last two estimates from the census, so the census one does an enumeration every 10 years, but then they estimate total population every year, and the components of population change. In the last 2 years, so between 2019 and 2020, and 2020 and 2021, the Census Bureau actually estimated a decline in total population in Massachusetts. So I think it's important to kind of talk about that, because if we are declining in population, it would again, another inhibitor to economic growth. These are the components of population change. I just want to draw out a couple of really interesting things. First, we have this purple bar here, it's our birth rate. And in our red bar here, it's our, or I shouldn't say rate. The purple bar is our total births, and our red is our total deaths. What we've seen over time is that the births have been declining slightly in Massachusetts. Part of this is a function of an aging population. Part of it is a function of a well-educated population. We have the most well-educated population in the country, and in particular, a well-educated female population with high labor force participation rates. So that tends to mean smaller families. Death rate, though, as we see, has increased pretty dramatically in 2020 and 2021, almost as if we were living through a global pandemic. So what we end up seeing, though, is for the first time in history that deaths are actually ahead of births. And so our natural increase in Massachusetts is a decline. There's a few other states that has occurred in, and there are a few older states that trend was actually happening pre-pandemic. But this was one of the things that we were expecting a little bit as baby boomers reached retirement ages, but with a global pandemic, it sped that up some. The next piece to this is international migration. And we see this green bar here, which shows the net change of foreign-born residents coming to the US versus those who leave. And that's been a net positive for us for a long time in Massachusetts. But as we can see, that increase net positive has diminished dramatically since about 2018. Part of this has been a function of federal policies related to the Trump administration, but secondarily, this dramatic slope downward in 2020 and 2021 is obviously related to travel restrictions around the pandemic. What this meant, and then here on this darker blue, or this aqua bluish kind of thing, is our domestic migration. And this is people who live in Massachusetts and move to somewhere else in the US. Historically, we've been net losers, and this would include immigrants who live in Massachusetts and then go off and move somewhere else. But we've historically been net losers there, and we've been particularly net losers in this recently. So the aggregate of this is that we have decreasing natural increase and decreases in total migration, which means at least temporarily, we're seeing population declines in the state. What's critically important inside this story is the importance of immigrants. For gains in the immigrant population in Massachusetts over the last 30 years have accounted for 80% of the labor force growth in Massachusetts. Immigrants tell an important part of our economic story, and they tell an important part of our potential to grow economically, especially if we're seeing a lot of folks retiring early and as baby boomers move into retirement ages. So federal policy around this in controlling a global pandemic has ramifications. A global pandemic has ramifications both in the short term, but the long term as we think about the economic growth in Massachusetts. All right, and then I'll do just a couple of things on the labor market crunch related to COVID. First, let's talk about Central Massachusetts, because that's where all of you guys are from. The graphic on the left kind of shows just, it uses a cool data source from the census called the On the Map, or the Longitudinal Employment and Household Dynamics Survey. What it uses is administrative records, and we can do some pretty cool stuff with inflows and outflows of workers. Looking at Worcester County, we see a pretty dynamic place where a lot of folks who come into the county, 120,000 people come in and work in Worcester County that live outside of the region, 232,000 who live and work in the region, but then a significant outflow as well, people who live in the county and are employed elsewhere. So it just talks about some of the important dynamics of the Massachusetts economy in general, and the place that Worcester County sits in particular as both a job center, but also a place that is significantly connected to other economies around the state, including Greater Boston. Things that stand out for Central Massachusetts as well, as we look at this graphic here on the right, shows the concentration of employment in different industries compared to the state. I think what's an important one to highlight is the importance of education and health services in Central Massachusetts. It makes up a third of the economy in Worcester County. This is a sector that was hit terribly during the pandemic, and I think would highlight any of the ways in which the region is maybe struggling to come out of the pandemic. An opportunity is in professional business services, where this has been a strength of the state, 17% of jobs, and it's lower in Central Mass, and that connective tissue to Greater Boston, I think, can highlight opportunities for growth. Looking a little bit about populations that were impacted during the recession in Central Massachusetts, the graphic on the left looks at the share of total unemployment claims for a region, and the bar on the right shows the share of total state labor force. So actually in Central Massachusetts, performed fairly well or better than other parts of the state, where the share of total claims was a bit lower than its labor force for the state. Places where it was, but the pain was felt pretty evenly throughout. I mean, the South Shore is like maybe the one deviation from that example. Unemployment not seasonally adjusted is 3.5% in the region, and I think what's critically, or it's been interesting, has been the growth of trade and transportation, utility jobs in the region. I'll highlight here a little bit about recovery in Greater Worcester as well. During the pandemic, the region lost 47,000 jobs, but it gained about 37,000 more since then, 38,000. But the big laggard right now continues to be education and health services, which has only recovered about half the jobs it lost pre-pandemic. It makes up a significant portion of the gap in recovery right now for Greater Worcester. Two other things I want to touch on real quick, or three other things I want to touch on real quick, is the conversation about the Great Resignation and the degree to which people are having a hard time hiring. The data that we're looking at here, the black bar looks at Massachusetts hiring rate. So this is the number of new hires over total jobs. And the red bar is the job opening rate, which is the openings over total jobs. What we see is job openings jumping up dramatically over much of 2020 and 2021, but the hiring rate actually dipping. So this speaks a little bit to these stories when people say, I'm having a hard time finding people to fill my jobs. Well, this data shows that, and showing that the opening rate has been outpacing the hiring rate. And I think ties back on some level to these other conversations about the decline in labor force size and perhaps some of the declines in total population. We got a lot of attention this summer about people quitting, the Great Resignation, as it were. These data kind of underscore that, the lighter green shows the US quit rate, and the more forest green shows the Massachusetts quit rate. Both quit rates increased dramatically during 2020 and 2021, although the quit rate is lower in Massachusetts compared to the US. We think that's because of the collection of industries that we have in the state, the concentration of knowledge-based industries. In a longer presentation, I do a few things about wages, but the quit rate is dramatically higher in industries with lower wages. What I think is important about the Great Resignation, though, and was probably misnamed, is it was really the great job change. And I think that there was an opportunity for workers to effectively tell employers in some cases to take this job and shove it, particularly when it came to low wage sectors. And we saw a little bit more movement for folks, and the wages increases that we've seen in some places probably highlight that point. Inflation gets a ton of attention, so I just want to highlight this, and Slav did a great job talking about this, and I think is more knowledgeable about this topic than me. But the red line here shows the growth, real growth in average weekly earnings for folks, and the inflation rate here is the little broken line. And I think what's important to highlight here is that despite the fact wages have been increasing, the impact on households, but it has the increase in wages is not keeping up with the rate of inflation. So this is where inflation has been going, but what its impact is on households. So your money is just buying less things. It is able to buy less things. And this has been consistent with all the stories that we've seen in the media over the last several months. Okay, and then question marks going ahead for the economy. Rising prices are tied obviously to supply chain issues, which Slav did a great job talking about, and I think is we anticipate mass benchmarks for that to relax as we get into 2022 further, but is obviously a significant concern. We expect, with mortgage rates going up, with low mortgage rates, housing prices jump dramatically, including several parts of the state. But, will that kind of help slow things down in terms of inflation is yet to be seen. Our expectations in Massachusetts is that their economy will continue to recover as we push into 2022. But the big concerns that I have going forward is what's happening with labor force participation, what's happening with our total labor force size, because you're not able to grow if there aren't workers to fill those positions. So I think that's a critical story for Massachusetts now, but more to the point for the long term as we go ahead. And I think the last big piece of this is that trying to identify and recognize the opportunities to build back better, as it were, to use a phrase from the Biden folks. But this recession highlighted vulnerability in a very unique way. And there are things about our economy that are quite strong, but what we have learned as a result of this recession is vulnerability is really concentrated in a handful of populations. And those are the kinds of things that we need to think about and address from a public policy perspective. And those are some more long-term things I would think about going ahead. So with that, I'll stop talking now and look forward to the panel.
Thanks so much, Mark. And yeah, feel free to just hang right out there in the Zoom room as you're going to take part in our panel discussion. And now let me take this as an opportunity to invite our panelists to join us here this morning. So we have Aaron Burt, the co-founder and CEO of Solvis Global, who'll be joining us to talk, and David Fithian, the president of Clark University. Aaron, let me start with you. You grew Solvis in the midst of the pandemic. You have more than 40 employees and over 40,000 square feet of manufacturing space here in the region. But tell us a bit more about Solvis.
Yeah, absolutely. So I wanted to start with a bit of background on me, because I'm one of those rare transplants into the central Massachusetts region, which I think is really an important story to capture as part of this whole kind of vision of economic recovery. So I actually grew up in central Pennsylvania, went to school at Lafayette College in Easton, Pennsylvania, and then came up here to WPI for grad school, right? So Worcester Polytech drew me in. And then the kind of excitement around entrepreneurship in the region is what kept me here. So I think there's a really cool story that we can tell around how you can use and leverage the education industry here in the region to really pull talent from around the country, and then you have to create a reason for them to stay. And the excitement about and around innovation and entrepreneurship is a theme that I'll keep coming back to, but it's one that I'm really excited about and really excited to participate in. So Solvus Global as an organization, we specialize in really two things, right? So the first is people. We say that our business is kind of standing the traditional idea of business on its head. So we're not technology first or core competency first, we're people first. And we have to be in our specific industry because what we're doing is taking and developing technologies from very early research stages out of university and government labs. And we're transitioning those technologies into full commercial entities. So the way we do that is we actually bring those technologies inside of Solvus. We pair them with really, really talented people, put a really unique business model around those technologies, and then we incubate it inside of our organization and transition and spin those companies out into standalone separate entities, all in and around materials and manufacturing. So we have focus areas in battery technology, in large format additive manufacturing, in feedstock supply chain for additive manufacturing, manufacturing intelligence software, and some really interesting work going on in actually supporting the scrap industry and helping make more money so that scrap can be more sustainable. So a lot of different areas in and around materials and manufacturing. Really excited to be here, talk a little bit more about, again, kind of innovation and entrepreneurship and how that's impacting our business as well as other businesses that we participate in. And can't thank you guys enough for having me here. Looking forward to the conversation.
Thanks so much. And I'm sure David, hearing Aaron's arc about where he went to school and now that he's remained in the region, that must get you really excited. Glad to have you here on the panel as well, David. As I said, president of Clark University, and you're no stranger to the campus. You were a student and now you've come back. And I think when people think about Clark, they probably think education first, but employment is a huge part of what Clark is really doing here in the region as well. Give us some more context.
Great. Thank you very much, Carrie, and good morning, everyone. And I want to thank Peter for inviting me to be part of today's discussion. I'm delighted to be here, and I'm grateful for the opportunity to talk to you about the impact higher education in Worcester can have on the economic future of the city, as well as the importance of higher education more broadly, which Mark and Slavik both spoke to some extent. I should say, coming back to Worcester in 2020, roughly 34 years after I graduated from Clark, I was awed and inspired by the exciting and positive changes that are bringing vibrancy to the city and to the surrounding region. And I really appreciate the sustained and strategic efforts that have made these changes a reality, including the start of businesses like Aaron's. As you know, Worcester's home to 8 colleges and universities with a combined 31,000 students. What you might not know is that higher education is Worcester's second largest industry. The Higher Education Consortium of Central Massachusetts, or HECMA, reports that roughly 10,000 residents of Worcester County work in one of its member colleges. In the most recent year for which they have data, HECMA reports that member colleges spent $66.3 million on products and services in the city of Worcester. As a sector, we are major employers. We contribute revenue to the city, and we serve as anchor institutions with physical presence in our neighborhoods. Research we're conducting at our schools is contributing to the health of our planet. It's deepening our understanding of urban challenges and addressing the mental health of our young people, among many other topics. And our graduates are well equipped to go to work in one of Worcester's growing industries. In short, higher education is integral to the economic life of the city we all love. And these positive impacts are all amplified when we intentionally work together with the community around us. If I could say one word or two about Clark. Clark itself has a long history of working with and investing in the city of Worcester, particularly in our home neighborhood of Maine South. Our partnership with the University Park Campus School, which we helped found in 1997, is just one example of this. From developing curriculum to ongoing teacher training to offering free tuition for students who excel in their studies, it's a model for how institutions of higher education can both enrich and be enriched by the community around them. Our recent adoption of the media arts and game design programs of Becker College, which kept these vital programs from leaving Worcester, is another example. I'm also excited about Clark's recent acquisition of 7 acres of land very close to our campus that had been vacant for over a decade. We fully anticipate and intend that this investment in our physical plant will be an asset to the neighborhood and to the city, in addition to Clark, and a source of pride for us all. And just as we're talking about the economy, Clark recently took advantage of what had been historically favorable financial markets to secure $100 million in new capital financing, which will enable us to make a number of capital improvements, including a brand new interdisciplinary academic building, which we will very soon announce and start construction on. So the opportunities are many, but there are of course challenges. And I want to mention one important one before closing out my comments here. And that's primarily the changing demographics, or what we in higher education call the demographic cliff, which is an anticipated sharp decrease in the number of traditional college age students, particularly in the Northeast. This is a major challenge for us, but also a major opportunity for us to think about how to reach non-traditional students and provide ever important changing academic opportunities for those students. So let me wind down primarily to say, I think the future of higher education in the Worcester economy really is going to be one of partnership, of working together to create employment opportunities, internship opportunities for our students, and really working to make institutions like Clark, but others in Worcester, to be ever more competitive. We can't compete in what is a very competitive landscape of higher education by trying to do everything that everybody else is doing and doing it in the same way. So trying to be competitive through partnerships is going to be absolutely essential. And I hope that we will have opportunities to engage with many of you across Worcester in just such opportunities. Finally, I'll just say that in higher education, we do need to do a better job of explaining the value proposition of a liberal arts degree, as well as advanced study and professional degrees. There's lots of research that demonstrates the lifelong impact that having a college education has on individuals. But given rising costs, there's no question that that value proposition is coming into question. That's going to be a really, really important factor for us. So again, thank you for letting me join you today. I look forward to the conversation.
Excellent. As do I. I'm really looking forward to speaking with all of you. Let me invite Aaron and Mark to pop back to screen as well, and remind all of the audience members, the participants, feel free to drop questions in the Q&A, and I'll get to those as we continue the conversation. But let me just start broadly, and Mark, I'll put the question to you first, but I was listening to Ezra Klein earlier, and he's a journalist. He was focused on the economy that day, and he talked about something that seemed really relevant to what we're talking about here today, the economy, but he was speaking about booms and busts, and that we know how to talk about each of those phenomenon, but what we really struggle with, you said, quote, is we don't know how to talk about this contradictory extremes coexisting together. But that's the economy that we have right now. And a lot rides on figuring out how to balance those extremes. So as you think through the economy, Mark, is that how you're thinking about it too, balancing extremes?
Yeah, and I'm glad you cited Ezra Klein, because he's one of my favorite journalists. And, you know, I think this boom and bust thing is, well, let me take it back a step. I think I touched on this a little bit in the presentation the other day, at the end of the presentation, with how COVID was such a great revealer of social inequality and vulnerability. And, you know, the alignment between COVID and then the, you know, kind of racial reckoning we saw at the tail end of 2020 as well. I mean, it really highlights something that's deeply problematic with our economy right now, which is that vulnerability is concentrated most specifically on folks with limited educational attainment, and folks with limited educational attainment are most often communities of color. And so we're 2 recessions in a row now that have been massive, and 2 recessions in a row now that have decimated Black and brown folks. And in communities that, you know, like, for example, on COVID, the most predictive social characteristic in a community of the COVID outbreak was overcrowded housing. And where was there the most overcrowded housing in Massachusetts? Chelsea and Lawrence. People don't, high immigrant communities, high Latinx, people don't live in overcrowded housing because they want to. They do it because of economic reasons. So I think for me, it's a broader way of shining a light on the fact that vulnerability has been somewhat easy to ignore for some folks because it's so concentrated in the folks who serve you food. And that, so how do we, one, provide social safety net support for low wage workers and vulnerable populations, one, and then two, how to provide more opportunities for skill acquisition and training so that folks are, we'll always have low wage work, right? But how do we help folks enhance their opportunity, the spectrum of opportunities, because the spectrum of opportunities are so tied to geography and are so tied to race and income. And this pandemic highlighted that dramatically, as well as this recession. And I just have to point out, like, if you go back 20, 30 years and you look at recessions, it was not that only poor people will lost jobs, right? And so I think that's something that is a very new thing that we've been experiencing. And it's something that we haven't really wrestled with in an important way.
David, I saw you nodding your head there for much of what Mark was saying. Do you want to add something?
Yeah, it's for us in higher education, it is definitely a balancing act, these extremes that we're seeing, and raises a lot of questions for us. How can we continue offering what students expect, which is more and more expensive, with the pressure to lower costs and increase access? How do we attract and retain talent and maintain equity when internal salaries cannot keep up with market forces, and we face pressures to keep, again, lowering our costs? How do we keep lowering costs in the context of, in the face of increased inflation, growing inflation? And how do we live up to our access mission in a context of growing costs and salaries? Finally, how do we compensate and offer the right benefits to our employees in the context of these growing costs and market forces on salaries? So for us, we're absolutely focused on access and affordability. There's no question that we want to create opportunities for all college-age students, but really particularly making opportunities for first-generation, multicultural, BIPOC students an absolute priority. So we're very much experiencing these extremes and trying to balance them, and it's going to cost, it's going to cause us really to rethink the model in which we continue to deliver education, which the way we do it at Clark and most of the institutions in Worcester is a very high cost model, because it's very, it's very focused on individualized small group instruction. And it's one of the things, but it's one other point. I mean, we're evaluated in terms of some of the national rankings on the number of classes we have of fewer than 20 students. It's just extremely expensive. And you don't really get some of the economies of scale between teaching fewer than 20 and teaching over 200. But we think that it allows us to deliver the most compelling education at the scale that we're doing it, but we really have these challenges of how to reduce the cost of delivering education that way.
Aaron, how about for you, balancing these extremes? We just heard David say recruit, retain, attracting those employees. Is that what you're focused on, or how are you looking at these two extremes right now?
Yeah, I mean, absolutely. So I think I'm in a very different world in terms of the innovation and entrepreneurship side. And if you look at venture capital investment and IPOs across the broader kind of startup industry, we're no longer talking about unicorns, we're talking about decacorns, and the numbers just keep going up and up. And so there's a ton of excitement and anticipation around, one, innovation and startups, and then two, around manufacturing. So this is the part that's really cool to me, is that in the last couple of years, particularly with COVID, what the supply chain challenges have revealed to us is that we have to rethink how we manufacture goods and services. And so what we're looking at as a startup in the manufacturing industry is a lot of growth potential. Now, the challenge that everybody's talked about here is that if you're going to grow, you need people and you need talent. So I mentioned early on, the number one thing that we focus on is people, because for our business, it's all about bringing the right people together to create that kind of economic driver and business opportunity. So for us, we actually don't look too much at degree or even specific expertise in a lot of our job openings. And we have 15 job openings for a 40-person company. That's a lot of jobs. And so we're looking for people who can grow, who can dive into problems quickly, who can overcome obstacles. We're not looking necessarily for somebody who has specific engineering degrees or who has some specific skill set. But the challenge is that, you saw that chart of all the job openings. It's getting through that noise. And so that's where I think there's a lot of challenges across, especially this region, is you do have a lot of manufacturing growth and manufacturing startups that are coming into this region. There's a lot more space here than there is in Boston, albeit that's still another issue to talk about. But there's a lot of excitement here, but it's really about figuring out how to match the people with the jobs and filter through all that noise that's out there, because it's difficult. And we're pretty fortunate. Our retention rates are fairly high because of the size and style company that we are. But as any company grows, having that kind of personal connection that a lot of folks are looking for in their jobs now, it's difficult. It's difficult, and it's difficult to balance all of the extremes that you have, even in the individuals that are part of your community of work, right? So I just gave a talk to our company the other day about, as long as we're in the middle and people are either happy or upset with us on either end of the spectrum, then we're probably doing our job right. But that's reality, is that we do have, a distribution of views in all things, from how work should be done to, what kind of food people want to eat. And we have to balance all of that. So it's definitely the extremes, but I think it's important to focus on the shades of gray in the middle. It's not just black and white, it's everything in between.
Yeah, you spoke there a lot about jobs, and we have a question about jobs from one of our guests, so I'll read it. It says, what can Worcester do to participate in job creation like Boston and Cambridge? And Mark, I'll let you dive in first if you'd like.
Oh, yeah. So I wrote a really quick and dirty response to that, but I think one of the things, my focus on it probably comes from a slightly more academic-y public policy angle. So I think some of this for me is state level initiatives, and trying to think more creatively about how to spread economic opportunity in Massachusetts and other places. Worcester has done actually quite well, right? And its location relative to Boston, its concentration of colleges and universities, the history of manufacturing in the broader region. I think all of this kind of sets up the region to perform pretty well as, like, second tier city in New England, right? Although New England doesn't have a lot of big cities. But I think that when we think about Massachusetts more broadly, the concentration of jobs or job growth in the East was very unhealthy, right? I mean, both in terms of transportation and in terms of housing prices. I live in Natick, and I had an office in Boston pre-pandemic. Commuting was the worst. And before that, I was on the Future Transportation Commission with the governor. And we talked a ton about like what telework would be, and it was hard to imagine a world where telework was real in a serious way, and now it is. So I think, to me, it's like the state thinking more strategically about, like, okay, well, how are the connective tissues between industries in different regions, but then also building those quality of life things that allow for a workforce to be somewhere and allow work to happen anywhere, right? So that's housing production. And that's a big problem in Massachusetts, because we are not keeping up with housing production relative to our population growth, and it's reflecting back in our prices. And then secondarily, it's things like 5G and in modern transportation. On the 5G point, you'd be surprised at the number of spots around Massachusetts that don't have high-speed internet, and what that is going to mean for the ability to have telework or to do creative things about, being able, hey, I only have to go into Boston twice a month so I can work anywhere, kind of thing, right? But the internet is going to be central to that. So I think those are some of the things, and some of that isn't the region doing it, but I think it's kind of thinking from a state level about how to support those things.
And that internet struggle is not some far off strange land. It's right here in Worcester County. There are people who do not have access to broadband internet or high-speed internet. It's a struggle for sure.
Carrie, if I could just jump in on
Please.
that is so critically important for higher education. And there's so many ways in which use of technology help to overcome some of the geographic barriers that Mark was alluding to. But then the issue of high-speed internet, also the issue of Mark mentioned overcrowded housing. You have a student trying to learn online in a room with siblings and others, really tough for certain students. But even at a place like Clark, where we have high-speed internet on campus, half of our students live off campus, and just a few blocks from our main campus, you have much different service. And so it's tough for our students, but clearly it's tough for residents of Maine South to have less access to high-speed connectivity, which is not only important personally to feel connected and be part of that world, but professionally and as I just said, educationally. So it's a critical issue for us in Worcester.
Absolutely. There's another question from the audience here. If the chronic supply chain issues from the COVID crisis are a wake-up call, how can the U.S. become more resilient with manufacturing? Aaron, you want to take a crack at that one?
Sure. So first of all, our wage rate is never going to be able to compete with manufacturing on a global scale anymore. So we've got to throw that out the window right away. So what that means is, and this is where all the excitement is right now, it's automation and advanced manufacturing. So it's building intelligent automated factories of the future using 3D printing, advanced robotics, all the things that we talk about and do all day long. The challenge with that, now we go back to the labor force, right? So if we want to manufacture in the US, we need people who can obtain, I'm not saying that they have to have the skills now, but can obtain the skills necessary to support these types of operations. So key areas for that, right? Robotics, not robotics engineers, but folks who can operate a robotic system. So robotic operators, robotic technicians, the people who actually are going to go around and service them. We need folks who understand how you can integrate different systems together to make those automated lines. Again, you need the engineers, which we've got a pretty good abundance of, but then you need that second category of folks to actually get that out there and do the work, get everything installed. And that's where we're seeing the biggest gap and the biggest weakness right now. And so if there's one area that policy-wise, both regionally and across the country that we should be doing, let's focus on that kind of job category. And honestly, the best folks that we've seen who come in and do that, it's the immigrants. So we've got to really open up the doors again and let that population flow into this region, because that's who we need. The folks that we've tried to tap that are most excited about this, they fit into that category. So I think it's getting that second category of kind of operations technicians trained up and opening the gates to folks from outside of our region and outside of our country to get them excited about this region.
If I can add a quick thing to that too, I think one of the things that I worry about as it relates to the pandemic in general is that like so many things in human nature, like when a crisis is behind you, you kind of forget about what you learned, right? And then I think so I read a really interesting book a couple months ago called Uncontrolled Spread by Scott Gottlieb, and who was worked in the FDA. And one of the arguments that he led the FDA, and he made an interesting point in it about seeing that our response to public health as a national security issue, not just a public health one. And this gets at the point that Aaron's just making now, is that we have not looked at onshore manufacturing as a national security opportunity for the United States, or as a national security issue. We've only looked at it as what is the cheapest way to make stuff, right? And capitalism that is the brilliance of capitalism on some level, but it's very short-sighted when you are thinking along just on a profit based set of motivations. So I think that talks about federal policy on some level, about like, how do we support having an infrastructure in place that allows us to deal with crises in a manner like this. And so to me, that's a little bit of a philosophical shift about how and what concerns me is that like this could be a little bit like, hey, well, we just pushed it under our bed, now we're fine. And so, but that to me was something that really stood out when I read that and said, oh yeah, I had never thought about it in that exact way, but the pandemic did shine a light on that precise issue.
I'll just
Go ahead, Aaron. I saw you
double
unmute yourself.
down.
Go ahead.
No, I'll just double down and reiterate that. I mean, so we do a lot of work with the federal government on the R&D side, and there is a ton of investment and concern around exactly that, manufacturing as a national security risk. And so it's a very interesting way to approach it. But in particular, now we talk about tying back to the advanced manufacturing side of things. It's actually even the act of bringing all of that automation back into the manufacturing ecosystem here is in and of itself a national security risk, because now you have connected systems without connected security. And so now all of your manufacturing infrastructure is also at risk. So it's a double-edged sword that we have here. And it's one that the government recognizes, but it's a question of whether or not we can resolve the challenges at the speed that it needs to be resolved at. And right now we're way behind.
David, I think if I could, I'll have you speak to a point that Aaron was making just a moment ago about workforce training. And how is Clark thinking about that issue to sort of help prepare tomorrow's workforce for companies like Aaron's and others in the region?
Yeah, thank you. I appreciate that question very much. And I often say to folks, if you think about the core business that colleges and universities are in, we're in the talent business. Our job is to go out and recruit and attract to our campuses the very best talent we can. And that's with students, with faculty, and with staff. And so it's an essential issue, not only for ourselves in making sure we're well staffed, but obviously in giving our students, both undergraduates and graduates, tremendous opportunity to go out and be successful in the world. And we do that through a broad-based liberal arts education, but we're also increasingly doing it through very specific certificate programs and degree programs for really hands-on practical training in a number of areas. We also have to think about professional development opportunities, again, to retain the talent that we're able to attract to our campuses. And I just want to go back for one moment, if I may, to Mark's point about quality of life issues. Really, being able to have a broad set of restaurants, being able to have activities for our students, faculty, and staff to participate into, having a safe, comfortable public space and parks and other things is absolutely crucial for our ability to attract folks to Worcester. And it's one of the reasons I'm so excited to see some of those developments in the city from just in the past 10 plus years and the sort of future direction that we're going in. But so on workforce development, it's absolutely critical, and partly because of some of the inequities on access to education, some of the differences in opportunities following education. And we're focused on it both in terms of the broad-based educational programs we've had, as well as really targeting opportunities for specific training in fields. And we'll see, and my colleagues and I have talked about the real dearth of practitioners, for instance, in mental health, an absolute crisis on college campuses. There's just a dearth of people who are willing to go into that work. We don't pay very much. And that's really going to become a national crisis for us, really focusing on how to attract people to go into mental health jobs. Healthcare overall is going to be critically important.
The time this morning is just zipping by, and I could talk with the three of you for hours, but I think maybe in the interest of time, I'll move to a final question for everybody. And David, I was reading your State of the University address, and something that you said that really stood out to me. I wanted to share it here with the group. You said, all that precedes this moment enables us to be bold if we so choose. And so with that in mind, I wanted to ask each of you, what's one business trend that you think that folks should be paying close attention to as we look to 2022? And Mark, I'll toss that to you first.
Yeah, and I think for me, if I can step back from business and maybe more like broad economic, I think the thing I'm most interested in right now is this trend in labor force participation, and like what's going to happen to the labor force in Massachusetts in general, right? So I think for me, that's what I'm going to be tracking really closely over the next couple of years, because we need workers, right? And we're seeing this really funky thing that's happening right now, both with folks retiring, but then also with the immigration stuff I noted before. And I'm curious to see how that shifts back, and because that's been a big part of our story for a long time.
Thanks, Aaron. How about you?
Take a different tack at this one. Listening. So the ability to actually sit down and hear all of the different viewpoints that we have across all the different areas that we're talking about in business, in manufacturing, in workforce development training. But really being able to listen to all of these, again, shades of gray in between the extremes, and being able to formulate a plan of action out of that. That's already exceptionally important, has always been important, but especially as the kind of spectrum of views continues to increase and continues to be louder and louder, it's going to be more and more important for everybody in the business community and beyond to be able to listen and hear what's being said and what's not being said, and take action out of that.
Absolutely. And David, how about you?
I think the boldest of the moment, the opportunities have a lot to do with higher education as being a kind of industry or sector that's notoriously risk averse, right? I mean, we move cautiously. Some people would say ponderously, or, it's like turning a cruise ship around, which arguably is one of the reasons why colleges and universities have survived for centuries, because we're not sticking our neck out very often. But I think this is a moment where things are happening so much more quickly that we can't afford to be that risk averse. We can't afford to be in a constantly reactive mode. We really have to move into a different mindset about thinking about how to anticipate and meet the challenges of educating citizens of this country, citizens of the world, in a way that's really going to position them for the most success going forward. And that's going to require that we take some risk, and that we act really with a kind of intentional, deliberate speed that we haven't often done in the past.
David Fithian, Aaron Bird, and Mark Melnik, thanks so much for your insights this morning, and I'll toss it back to Peter.
Awesome.
Carrie,
Thank you.
I know last time I disappeared when I was introducing you, so hopefully I'll make it through the next 2 minutes. That was a fantastic conversation. And, I was saying earlier, geez, if we have wrapped it up by 10, we should end early. But now I wish we had set it for 10:30, because there's just so much to dig into. So, Mark and David and Aaron and Dr. Sheremirov, thank you all so much for, being part of this conversation. I'm looking at sort of the number of folks sticking with this broadcast. There's little numbers below, and it's just been, we've had the audience spellbound, which is a great measure of success. So thank you all for participating. I just want to now, and this is revealing, just go through the economic forecast winners from last year. Mark, it made me think of your comment that said, I used to be able to fall out of bed and do my forecast. And these last couple of years, that has not been true. So let's go through the winners. We'll be sending you a link to the survey for this year. So the first slide, this is Top Economist of the Year Award, where we asked attendees, where was the Dow average going to land? We asked them last February, where's it going to land? The three closest were Kathleen Glowacki from Bartholomew and Company, Peter Russell from the Sullivan Group, and Barnaby Horton from Merrill Lynch, 36, 338, and they were pretty close. The next slide, GDP growth. 5.7% was the answer. Barnaby Horton had an aggressive 6%. Closest, it finished in first, Karen Shapiro from Provo Wealth Management, 5.2%, and Chris Verico from Middlesex Bank, 5.2% also. The next question was unemployment. And we found our way to 3.9%. It was quite a ride. Kathleen Glowacki, again, first place, Bartholomew and Company. Kevin McGovern from Fallon Health chiming in at 4.66, and Tom Quinn from the Research Bureau had 3%. Those are the three closest. And again, Tom Quinn got the Massachusetts unemployment rate almost right, 4%. As Mark had mentioned, we're at 3.9. Patrick Wimbley from Rockland Trust and Raj Melville were the other two closest. And next slide. The overall winners, and this is total points added up, Kathleen Glowacki from Bartholomew and Company first, Kevin McGovern from Fallon Health. He sent me a note and said even a blind squirrel finds a few nuts when I told him he was in the top three. So Kevin, congratulations. And Barnaby Horton from Merrill Lynch, Bank of America, Merrill Lynch, was in third place. And I just want to mention the other two questions that didn't have enough answers to be included in the total contest. But we asked people in February, when would the US hit 200 million fully vaccinated people? And guesses were between April and June, 90% of them. The most pessimistic was Raj Melville, and he said September 30th, and the answer was December 9th. So that was really interesting to look at that. And the other one we asked was inflation, which is a very dull question for the last several years. The highest inflation rate guessed was Carmelita Bello of Bello Consulting. She guessed 3%, and it ended up being 7%. So I'm glad we got all the answers today, but things might shift. So let's check in with your economists before the year end. Anyways, thanks to everyone. Thanks to our sponsors, Bank of America. Thanks to our corporate sponsor, Bolus Lynch and National Grid. And thank you for all who have attended and participated. It was a lot of fun. Really appreciate it. Here's to a great year. Adios.